A global fund is often seen as the ultimate choice at the core of a long-term portfolio, with plenty of beginner investing videos recommending a set and forget it approach with a global fund. But with so many global funds available, how do you actually know which one to invest in and pick the right ETF for you? Well, in this video, we'll explore a range of global ETFs, break them down, the key differences, and highlight what to watch out for so you can make a more informed investment decision. My goal is to provide you with the in-depth knowledge and understanding that other videos often miss. By the end, you'll feel confident in knowing what to look out for when picking between global funds. However, to be clear, this isn't a video about whether a global fund is suitable for you. I have no idea. I'm not a financial advisor. I'm just providing information and helping you do your research. The final decision is only one that you can make. Think of this video as a resource to help you build that foundation to do your further research. And of course, always remember that when investing, your capital is at risk. Before we dive into the how, though, let's briefly discuss the what. Global funds are investment vehicles that provide exposure to stocks from multiple countries all around the world. However, it's important to understand that not all global funds are truly global. Some that are labeled as global and have global in the name actually only include developed markets, focusing on established economies like US, UK, Japan, and Western Europe. In contrast, truly global funds contain stocks from both developed and emerging markets together. And this will include stocks from countries like China, India, Brazil, Taiwan, and so on. In this video, though, we'll go through both types of global fund. For simplicity, the funds we'll be discussing today are all market cap weighted. What this means is that companies with a higher market value will have a greater weighting in the fund. For example, let's say Apple is worth $3 trillion and a smaller company is worth about $500 billion. Apple will have a significantly larger weighting in the global fund, and therefore movements in the Apple share price will have a greater impact, a larger influence on the fund's performance. You may also notice that global funds are often dominated by US stocks. That's not because they're biased, but simply because the US stock market is the largest in the world at the moment. However, market cap weighted funds automatically rebalance over time, so if things change in the world, then so will the weightings in your global fund. That's the beauty of natural rebalancing. This is why global funds make a simple and effective solution to capture the performance of the global stock market. It's all done for you. It rebalances to reflect the state of the world. The companies with the most influence today may not necessarily be the giants in the future. And by investing in a global fund, you don't need to worry about picking and finding the next big companies. Okay, so all the ETFs discussed today are available on Trading 212, which is one of my favorite low-cost investment platforms. But if you use another platform, you can still follow along. This is all still applicable. ETFs are the same on every platform, of course. I'm just not sure if they'll be available on the platform you use. If you do want to try out Trading 212, though, you can get a free fractional share worth up to £100 by signing up using the link in the description. Alternatively, if watching on TV, you can scan the QR code on screen now with your phone. And if you've already opened an account, within 10 days, you can use my promo code TOM in the menu page of the app to claim your fractional share. Now, this is an affiliate link and code, so what this means is that if you do use it, I do get something too. Thank you, I really appreciate it, and it helps make this content possible. Now, before looking at some actual global ETF options, I'll now introduce the key terms I'll be mentioning for each one, and more importantly, what you need to know for your own research. First up, distributing versus accumulating. Like with any type of ETF, a distributing global fund pays out dividends as cash into your investment account. On the other hand, an accumulating ETF reinvests the dividends at fund level. This in turn increases the fund's value. Whilst you won't see these dividends, the share price performance reflects the impact of those reinvested dividends. The total return for both is likely to be the same. It mainly comes down to preference. Next, index benchmark. This is especially important for global funds to research into. As mentioned at the start of the video, an index may have global or world in the name, but actually only be a developed markets index. I highly recommend checking the key investor information document of the fund, which your broker should provide or you can find on the fund provider website, to see what index the ETF actually tracks, and then take the name of that index and Google it to see what the index actually aims to do, and then resultingly, what is actually going to be inside that ETF. Okay, you also need to consider replication method. This refers to how an ETF actually tracks its index benchmark. There's full replication, meaning the ETF replicates the index by holding all the stocks in the index. It holds all the securities. There's sampling. This means the ETF holds a representative sample of the index's securities. This is quite common for a global fund because the index that they track can contain thousands and thousands of stocks, and the fund provider may think it's not efficient or unnecessary to actually include every single one of those thousands of companies. Lastly, there's synthetic swap-based replication. This is where the ETF uses derivatives to replicate the index performance. However, in this video, I won't go into too much detail about it because it is quite rare for a global fund to use synthetic replication. I don't think I've come across it that often at all. They're most likely going to use physical sampling. However, it is still worth knowing about synthetic replication, and I do cover it more in other videos where that replication method is more popular. Next up, trading currency. This is the currency that the ETF is listed in on the stock exchange. UK investors probably want to stick to ones that are trading pounds or pence to avoid foreign exchange fees on transaction. Whereas if you hold euros or dollars to avoid FX fees, you want to look for an ETF that is listed in euros or dollars. In my opinion, there's no point paying the foreign exchange fees when you don't need to. Moving on. Total expense ratio. This is the estimated annual cost of owning an ETF, covering management fees and other expenses. Next up, we have fund size, the total assets managed by the ETF. This is important because larger funds often have better liquidity, meaning it's easy to place an order, buy and sell large amounts, and also it may have a better bid-offer spread, a more favorable bid-offer spread. And speaking of bid-offer spread, this is the difference between the price you can buy a share of an ETF at and the price you can sell one at. So the closer those two numbers, the less money you're going to lose on transaction. This is not a fee charged by your broker. It's just part and parcel of market trading. As mentioned, larger funds with higher trading volumes and liquid underlying assets have narrower spreads usually. Remember, spread is not static and changes constantly, so it's good to check this yourself on the London Stock Exchange website and then do a simple calculation to get a percentage spread. In general, for global ETFs, this spread will vary more than with S&P 500 ETFs due to the differences in fund size and popularity, but also the fact that they contain stocks from emerging markets that may be less liquid. It's definitely worth checking the spread before making any large trades and picking between ETFs. An ETF may have the lowest total expense ratio, but it may have a very unfavorable bid-offer spread, which when you balance the two may mean the lowest cost ETF in terms of TER is not the lowest fee overall. Okay, with the terminology out of the way now, let's explore some of the most popular global ETFs on Trading 212 and the differences between them. Just like with the S&P 500 video last week, I'll be referring to the tickers for the versions of the ETFs listed in GBP. But if you are an investor who would prefer ones that are listed in euros or dollars, you can simply use a website like Just ETF to search for the ETFs mentioned here, and then go on the stock exchange tab, and you can see if this ETF is listed on another stock exchange in a different currency. It most likely will be. Okay, we're going to start off with global ETFs that only contain stocks from developed markets. Now, you may well be thinking that's not truly a global fund if it only contains stocks from developed markets, but I have to stress that a lot of funds named as global are just developed markets funds. And I'm not here to argue that a developed markets fund isn't globally diversified. It still contains a lot of stocks. And you may well have a good reason for wanting to exclude emerging markets. Again, it's completely up to you. There are a lot of developed markets indexes that ETFs track, but the main two to look out for are FTSE Developed and MSCI World. The FTSE Developed Index includes large and mid-cap stocks from 25 developed markets countries. On the other hand, MSCI World includes developed market stocks from 23 developed countries, with the two countries missing compared to FTSE Developed being South Korea and Poland. Also, briefly focusing in on MSCI World here, looking at the name, I think this index perfectly proves my point about confusing terminology and names here. Despite having world in the name, it does not give all world exposure, it's just developed markets. So you can see how beginner investors and people who do not do further research can be misled into thinking they have a truly global fund when investing into an MSCI World ETF. It's always important to check that underlying index and what it actually includes. Again, whether DM only is a good or bad thing is completely up to you. It's just something to be aware of. On to the ETFs. First up, we've got Vanguard's FTSE Developed World ETF. The ticker for this one is VEVE for the distributing version and VHVG for the accumulation version. Due to Vanguard's name recognition, this is one of the most popular developed markets ETFs on Trading 212. Remember, whilst there's not necessarily anything wrong with this ETF, most popular does not equal best. It just means it's the one that most people are aware of. It uses physical sampling, according to Just ETF, but from what I can see, it holds a very similar number of holdings to the actual underlying index, so it's pretty close to full replication in practice, I think. The total expense ratio of this ETF is 0.12%, so definitely pretty cheap. And in terms of fund size, as of making this video, according to justetf.com, the fund size of VEVE is £2.7 billion and £2.9 billion for VHVG. So pretty big ETFs. There can be no problem with liquidity here. Remember, fund size is not a static amount and changes constantly as a result of stock market performance and the popularity of the fund. Next up, we have a much less well-known FTSE Developed ETF, the Franklin FTSE Developed World, ticker WORL, accumulation. As far as I'm aware, there's no distributing version available, so it's just the accumulation one here. Importantly, this ETF only launched in 2024, so there's not really much past performance data to go off. So when you go about looking into past performance and comparing, just keep that in mind. It uses physical sampling as a replication method rather than full replication. According to the Franklin Templeton website, the fund holds around 1,400 stocks compared to the roughly 2,000 in the index benchmark. The expense ratio for this ETF is just 0.09%, so they are undercutting Vanguard here. And this may be achieved through that use of sampling and holding less stocks in the actual fund. In terms of fund size, it is currently a very small fund with a size of just £6 million. Now, this is probably because most people simply just aren't aware of it yet, but a fund being this small is certainly something to be aware of. It may take longer for large orders to go through due to the small fund size, and it may have an unfavorable bid-offer spread, but you'll need to double check that. Moving on, we're now turning to MSCI World ETFs. Now, there's absolutely loads of MSCI World ETFs. If I listed every single one, I'll be here all day. So if you're wondering why I haven't mentioned this one or that one, that is why. There's just so many. But I am going to go through a couple of the most popular to give you some idea and the sort of things to look for. Starting off, we have the HSBC MSCI World ETF with the ticker HMWO for the distributing version and HMWS for the accumulation version. The distributing version has been around for significantly longer than the accumulation version, so keep that in mind when looking at past performance. It uses physical sampling, but according to the fact sheet, it does hold a very similar number of stocks in the fund to the actual underlying index. So maybe in practice, the sampling, like the Vanguard fund, is quite similar to full replication. It has a total expense ratio of 0.15%, and the fund size is nearly £8.5 billion for HMWO and £634 million for HMWS. Another MSCI World, and one of the most popular at the moment, is the SPDR or State Street MSCI World ETF with the ticker SWLD. And this is an accumulation ETF. I don't believe there's a distributing version available. This is another one that apparently uses physical replication, but in practice holds a very similar number of stocks to the underlying index benchmark. The total expense ratio for this one is cheaper at 0.12%. Finally, the fund size is just over £8.1 billion, so a pretty big fund. We'll leave it at that for MSCI World ETFs, but as I say, we could go on all day. There's a lot more by a lot of different providers. But we'll now move on to fully global ETFs. For global ETFs that contain both developed and emerging markets, there's two main indexes to be aware of: FTSE All World and MSCI ACWI, All Country World Index. They both contain large and mid-cap stocks, with FTSE All World including 48 countries and MSCI ACWI 47 countries. There are some small differences in the countries included, but nothing I personally would give too much for. In practice, they're going to be incredibly similar. Okay, getting straight into the ETFs. First up, by far the most popular and most discussed, is the Vanguard FTSE All World, ticker VWRL for the distributing version, VWRP for the accumulation version. It uses physical sampling as a replication method, but includes a significant amount of the stocks in the index, about 3,650 out of the roughly 4,250 in the underlying index. The total expense ratio is 0.22%. So you can see it is more expensive than a developed markets fund, probably due to the inclusion of emerging markets and the fact that those markets are a bit more expensive to track usually. In terms of fund size, it's massive, £12.8 billion for VWRL and £14.1 billion for VWRP. This makes it one of the largest truly global ETFs available and means liquidity and spreads are never going to be a problem here. Next, we have the Invesco FTSE All World with the ticker FTWG for the distributing version and FWRG for the accumulation version. It's important to note that this ETF only launched in 2023, so there's limited past performance. It also uses physical sampling but contains fewer stocks than the Vanguard FTSE All World. The advantage here is that it has a lower TER, total expense ratio, of 0.15%, which is quite competitive. However, the fund size is much smaller, only £77 million for FTWG and £800 million for FWRG. This means in practice, the liquidity and spread may be less favourable than the Vanguard option. So you've got to weigh these things up. Okay, moving on, we have the iShares MSCI ACWI, ticker SSAC for the accumulation version, and as far as I'm aware, no distributing version is available. This fund uses physical sampling and holds around 2,300 stocks compared to the roughly 2,600 in the index. It has a TER of 0.2%, which is slightly cheaper than Vanguard. And importantly, it has a massive fund size of £13.5 billion, putting it in the same league as Vanguard's offering in terms of liquidity and trading efficiency. Finally, we have the less well-known SPDR MSCI ACWI with the ticker ACWI accumulating. Again, I do not think there's a distributing version available. This one also uses physical sampling and contains a very similar number of stocks to the iShares version. And the total expense ratio for this one is an impressively low 0.12%, making it the cheapest truly global ETF on Trading 212 at the moment, listed in GBP. Importantly, this was only recently cut down from 0.4% in August 2024. So it went from being one of the most expensive global ETFs to one of the cheapest. This is important to know because when you're looking at past performance, performance, keep in mind that that past performance is when the fee was higher. So going forward, you would expect it to track the index better because 0.4 to 0.12% is a massive difference in fees. So I do think it is pretty useless to look at the past performance of this ETF you're comparing when the fees were higher. The fund size is £3.3 billion, which is substantial, not as large as Vanguard or iShares, but certainly large enough that I personally wouldn't expect there to be too much difficulty in terms of liquidity, and the spread is probably quite favourable as well. So that was a run through of some of the most popular and cost-effective choices currently available. As always, make sure to do your own research and check that the specific index and ETF structure match your investment goals. So now that we've broken down the details for each ETF, you may be thinking, which one is right for me? Well, I can't give the answer to that. Unsurprisingly, I'm not a financial advisor, and the answer really depends on your preferences and individual circumstances. By now, though, I hope you feel better equipped to make your own investment decision. First of all, ask yourself, do you want a truly global fund, or are you happy with just developed markets? There's no right answer here. Then consider whether you want a distributing ETF or an accumulating ETF. How do you want the dividends handled? At the end of the day, this comes down to preference, as the total return for both, if you reinvest those dividends, will be very similar, if not the same. If looking at the one with the lowest fee, just remember that sometimes lowest fee does not always equal best due to tracking error, bid-offer spread, liquidity, all those other things that you need to consider. To finish the video, here's something to keep an eye on. Just last month, 2 new ETFs were listed on the London Stock Exchange by Amundi. These are not yet available on Trading 212. There's MWOS, which is the Amundi Prime Global ETF with a TER of just 0.05%. Amundi Prime Global used to be listed on the London Stock Exchange, but it was delisted and they've now relisted it. But the key difference is this time it's domiciled in Ireland rather than Luxembourg, which is more favourable from a withholding tax perspective. And then there's also PACW, PACW. So this is the Amundi Prime All Country World ETF with a TER of only 0.07%. So this will be the cheapest global ETF from a TER perspective. They do track selective indexes rather than the more popular and familiar FTSE and MSCI indexes, but it's definitely something I'll be keeping an eye on and seeing how they perform, the spread, liquidity, and so on. That is it for this video. At the end of the day, the aim is to help you understand the differences and conduct your own research. The most important thing, in my opinion, is actually investing. Don't get bogged down too much in the tiny details. It may just be a distraction. And avoid swapping ETFs too much, because every single time you swap ETFs, you're losing a small amount of money to that spread. So people that are constantly making trades may be losing more money to spread than they realize. Finally, remember, this is no way a recommendation to invest in a global fund. It's simply to provide those details. I have no idea if a global fund is suitable for you. If unsure about anything, consider consulting with a financial advisor. If you enjoyed this video though, consider liking and subscribing for more investing content. As always, thank you for watching, and I hope to see you in the next video.